Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Ben Carlson, director at Ritholtz Wealth. We start the conversation with Ben around content, given he's perhaps one of the most widely read investment bloggers on the internet. We talk about his writing process and how he's maintained a focus and commitment to making finance understandable through the posts on his blog, A Wealth of Common Sense. We then get into the markets and get his take on inflation, bear markets, housing, and more. We wrap up with some important investing lessons, and as you'll see, Ben maintains a very thoughtful, rational, and humble approach to how he views the markets. As always, thank you for listening. Please enjoy this discussion with Ben Carlson of Ritholtz Wealth Management. Just one more thing before we start. Excess Returns has been growing a lot recently, and all of that is a result of the support from our loyal listeners and viewers. We just want to thank everyone who's taken the time to listen to us and for supporting us and allowing us to continue to reach more and more investors. If you have a minute to do it, we would ask one favor of you. If you have benefited from the podcast and could take the time to subscribe on YouTube or your preferred audio platform and to write a review, that would be greatly appreciated. Both are a big part of expanding the podcast and will allow us to continue to get great guests. Thank you so much. We really appreciate it. Hi, Ben. How are you?
Hey guys, how's it going?
Thanks for joining us. We're excited for this conversation today. So we're going to kind of chunk this out into three different parts. We're going to do sort of content, talk about your blog, how far you've come with your blog, talk about sort of investing in the economy and the markets, and then sort of wrap up with, I guess, like lessons learned and things like that. But I guess to start, and then this is going to probably sound really cheesy, but we are huge fans of your blog and the writing that you do. So anyone listening to this, we highly encourage you go to A Wealth of Common Sense and subscribe to Ben's newsletter because it's excellent, it's topical, it's digestible, he's consistent, uses data and sort of a long-term orientation with the things that he's talking about. And what I would also say, and one of the reasons I personally believe that you and your colleagues at Ritholtz have had so much success is because of the authenticity of who you guys are and how that comes across in the writing and the things that you do. So congratulations to you guys. And we're big fans over here.
It's weird because if you would have told me 10 years ago that I'd be producing content on the internet and that'd be a big part of my everyday job, I would have said you're crazy because I kind of did it on a whim. It wasn't like I had a big master plan, like I'm going to start this blog and that's going to lead to me working at a different firm. It was more or less, I was just kind of bored. I was getting my MBA and I had a guy in one of my classes who had a blog and he said, hey, check this out. I have a blog. And I kind of thought I could do that. I could write about finance. And he showed me how to make a website. And this is back before it was really easy. There was no Substack or anything. And he helped me with WordPress, put a few things in and put a header on and just go to town. And I did it with no expectations. And so the fact that it's led to some of the things that it's led to was surprising to me. And I think one of the reasons that it did kind of last a while is because I didn't go into the expectations. Because I know a lot of people these days say, I'm going to come in and I have a content strategy. I'm going to get a big audience. I'm going to do this, this, and this. And some people certainly can do those kind of things. But that was never really my MO at the time. It was just kind of, I was a little bored at work and looking for something new to think about and put myself out there a little bit, and it just sort of happened.
Yeah, the one thing I would say is I went back to your very first post because I was curious myself. I'm like, how long has he been doing this? I thought actually you had been doing it a little bit longer. You've been doing it a long time. You started, I think it was February 2013 was your very first.
Yep, coming up on 10 years now, which is kind of crazy.
And what was cool in that is you talked about your upbringing, your parents, and how you had good guidance from them, and that played an important role in your overall financial habits. But I just think the mission that you laid out 10 years ago, you're still actually executing on that. And that's very unique because I could see how it'd be hard to drift over time.
Yeah, I basically started writing for my friends and family because those are the only people that were reading at the beginning, probably for the first, 12 months or so. And that's one of the reasons I started it is because I would have friends and family come up to me all the time. Hey, you're the investment guy. I have a question about the market or my finances. And I thought, I'm sick of answering these questions. I'm just going to start a blog and I'll put your email on it and you can read and I'll write stuff that's geared towards that audience. And the surprising thing to me was after about a year, I started getting questions from people in the investment industry saying, hey, I like the way that you laid this out. Can I share this with my clients? And I never thought of it because I worked in the institutional space. I was working with endowments and foundations. I wasn't in wealth management with families or individuals. I was working in a totally different space and wasn't really taking on clients, right? I worked for an investment office that managed money for a wealthy family, and that was we had one client. And so it was kind of surprising to me that advisors were saying, we're having a hard time explaining what's going on in the markets or explaining these concepts in a simple way. And you seem to be doing that. And it's not like I had this master plan to do that. I was literally trying to explain complex stuff to people who aren't in the world of finance. And the light bulb moment for me was, oh, wait, all the clients that these people have, they're not in the world of finance either. And I think that's one of the funny things about this industry is that there's so many people that try to impress you and talk and use jargon and make things so complex, but they don't realize that their clients, most of the clients don't want that. They want it to be simplified. And that was to me oh, actually this kind of makes sense. I kind of fell backwards into this thing without even realizing it.
I was going to say, there's a couple of different things there. I mean, why do you think in finance we tend to overcomplicate it? Are we just trying to substantiate the high amount of fees that we're being paid, or is it just we're not good communicators, or what? I mean, why do you think this?
So I don't know where this one came from, but there's a story about a locksmith apprentice, and he's learning the trade from a master locksmith, how to pick locks, right? So people would call him and come, I locked my keys in my car, come help me. I got locked out of my house, come help me. And the guy would come with all his tools, and it would take him a half hour to pick the locks, right? He's using all these different tools and he's getting at different angles. And by the time he's done, he's all sweaty. And the people thought wow, this guy put a lot of work in. And they gave him a huge tip because this guy obviously did his work. Then as he got better and he went along, it didn't take him as long because he learned the tricks of the trade, and he could get to a lock and he knew exactly what tools to use right away. And he'd put it in and he'd turn it and it would open in a minute, and he stopped getting tips. And the people thought that's easy. This guy, it's easy. Anyone can do this. And it's the opposite, right? So I think people in the world of finance assume that more effort means better results. And in some areas of life, that's true. But in most areas of it, but in finance, that's not necessarily the case, where doing more actually helps you. And in a lot of cases, doing nothing is the right thing to do most of the time in the world of finance. But if you're being paid by clients, you can't just sit on your hands all the time because it looks like you're not helping or doing anything.
By the way, when you get this huge influx of subscribers because you've appeared in our podcast, you'll know where they came from. Give them the side. But where was there a tipping point after the blog? Was there a tipping point for you where it went from, I don't know, maybe a couple hundred people reading, or maybe 1,000, to you really saw the hockey stick sort of growth in terms of traffic and subscribers?
I think it was slowly but surely. I think the biggest thing for me was I reached out. The reason I got into blogging in the first place, because I started reading other people's blogs. I was, after the global financial crisis, I was trying to figure out what happened because the mainstream sources of news weren't really explaining to me. So I kind of stumbled into blogs. So I was reading Barry Ritholtz and Josh Brown and Todd Harrison and Doug Cass and these guys who'd been doing it for a long time. And so that kind of got me interested in it. And I think part of the thing that helped me was that I reached out to some people, and they already had big audiences. And so Josh Brown was one of the first ones that really, I kind of sent him some stuff and said, hey, I like the way you're thinking. Here's something that I wrote. Maybe you'd find this interesting. And to my surprise, Josh wrote me back right away and said, I love this. And he started sharing. And then Tada Fuscanta, who has Abnormal Returns, who shares all the best in blogging and financial media every single day, he started linking. And so it was these places that had bigger audiences that started linking to me. And that's when I thought okay, I've kind of made it. These people who I respect their opinions, they're sharing my stuff with their audiences, and their audiences are much bigger. And that sort of helped it grow. I don't remember exactly when that happened, but it took, a good 12 to 18 months probably. And when you first start out with this stuff, at least I did back in the day, you're checking the traffic stuff every day, right? And it's very slow and middling, and nothing happens. And you look at this stuff all the time because you want to see that growth. And yeah, it took a long time and a lot of consistency for it to happen.
Yeah, definitely. With content, it's like a long-term compounding thing. It's not like you just start writing and, people are reading it. It takes time. It takes people sharing it. Links back to the articles are very important. I love Tadas's stuff. It's one of the emails I basically don't delete each day because there's so many good things he's highlighting in there. I want to ask you about sort of your writing process a little bit, and how do you, one, you're writing every day, even on Saturday and Sunday, correct?
Yeah, I like to write a little bit every day. Yes.
Yeah. So, do the ideas come to you just easily and naturally? Or how is your sourcing of ideas? I guess that's the first question. And then one, like, how would you say your writing has changed over time, and what could like a younger writer maybe learn from, I don't know, maybe some of the hacks or some of the improvements you've made in your process?
Well, you mentioned going back and reading the first post. If I go back and read old stuff I wrote at the beginning, I kind of cringe because I can see that I've improved over the time, but you probably say the same thing 5 years from now. I think the biggest thing for me for writing consistently, I just have to do it because there's an old quote that's, I can't remember who said this, but I steal it from Barry Ritholtz all the time. It's like, I write to learn what it is I think. And so I think I'm just a naturally curious person. And part of that is because when I came into the investment world, I didn't know anything. I came in with a clean slate. I was never one of these people that, like, my dad put a Barron's in my hands when I was 9 years old and I'm picking stocks with him and reading the Wall Street Journal. That was never me, right? I had way too much fun in college. I didn't know what I wanted to do. It got to like my senior year and I realized, like, oh shit, I have to do something with my life. What am I going to do here? And I got into the investment industry, kind of backed into it through an internship and found a job. And then I got into the industry and realized, like, oh, these people know way more than I do. I have a lot of catching up to do. And it was like, I probably should have learned a little more in college, and now I need to like catch up. And so I just read everything I could. Every person I saw, I'd ask, what are your 2 or 3 favorite investment books? Because this is before blogs were big. This is the early 2000s, before blogs were big, before podcasts were here. So I read a bunch of books, and I went through the CFA program, and I went on kind of a journey of self-study. So I think I'm naturally curious. So I think that helps. I think you also need to have a sort of worldview about how things generally work. You have to have like an overarching philosophy. So I have this general, you mentioned the philosophy is pretty similar for me. It hasn't really changed that much. I'm sure there's been some things I've updated my priors on, but the overarching philosophy is similar. And I think what you do then is you take that overarching philosophy and you input it into what's going on today in the markets, right? And you kind of talk about it through the lens of, here's what's going on and here's how my philosophy sees this as these things are changing. Because the building blocks of I think personal finance and investing, if you have a overarching philosophy, they shouldn't really change all that much over time, right? The markets are going to change, cycles are going to be different, you're going to be at different places in the environment, whether it's the economy or the markets, but that most of the stuff is, the building blocks are going to be pretty similar. So I think it's just taking that stuff. I'm not trying to like reinvent the wheel. A lot of times I'm borrowing from other people if they've created a chart or a data point or research. So I'm constantly reading and not trying to come up with unique thoughts all the time. It's kind of, here's what's going on, here's my opinion about it, and here's how my worldview fits what's going on right now.
With respect to your process, some writers we've talked to will say like, all right, I set aside an hour every day, and whether I have any ideas or not, I'm just going to force myself to write. And then other people say, it just comes to me. Like if it comes to me at 7:30 at night, I just start writing. Like, how do you think about that? Like how your writing process works?
Yeah, mine's probably a little bit of both. I do like to write a little bit every day, but it's not like I say every day from 8:15 to 9:15 I'm writing. It is kind of the thoughts come and go. And I think part of it for me is like getting away too. I'm a big runner, so I go jogging 4 or 5 times a week, and I find I get some of my best thinking done then, when I can kind of get away from the screens and get away from the Twitter and the news and all this stuff and just think a little bit. And so that's almost my kind of meditation period where I can kind of just be out there and thinking about this stuff. So I do like to write a little bit every day, but I also, if you looked in my blog folder on WordPress, I probably have like 300 drafts that have never been published. Stuff that I started writing and it never came fully formed. I never got to a good conclusion. I never got to the right place where I wanted to get it. And I just kind of left it in the draft folder. I should probably delete some of those. But yeah, I do think that writing is like this muscle that you can do it a little bit over time and get better and practice. I was never like a born writer where like in high school and college and when I was in school that I loved to write papers and stuff. I didn't at all. I was not a big writer at all. I actually didn't like reading that much. It wasn't until I found a subject that I enjoyed, like the markets and like finance and the psychology behind it, that I thought, oh, if I found this topic I actually enjoy and like to write about, I can do it more. And the more I wrote, the more I wanted to write even more, because I found it was like a very cathartic process to get my points across, because it helped me think through the things that were all jumbled up in my head.
Yeah, it's funny, like, in reference to like taking the walks, it's the same thing Morgan Housel talks about a lot. Like people ask him like, what is his process? And he talks a lot about just taking walks and just thinking. And, that's a huge part of what he does before he ever gets anything like written down. So I think that's probably common among a lot of writers.
Yeah, I think if you're just sitting there staring at stuff all day, and it's hard to detach yourself from what's going on in the immediate time right now. And I do always try to bring a lot of my stuff back to, I'm talking about stuff that's happening in the short term, but I like to bring it back to the long term, as you mentioned, Justin, because that's just sort of my overarching philosophy. So a lot of it comes down to thinking of new and different ways to say something that's probably already been said before a million times. You just think of a different way to get people to understand it or relate to it.
I want to switch and talk about podcasting, the other part of what you do on the content side, because when Justin and I originally started this, it actually, the inspiration from it came from you guys, because you guys had sort of talked at the beginning of Animal Spirits how, well, we were talking on the phone all the time, so we might as well just record it. And we're like, oh, we're talking on the phone all the time too, so we'll just go ahead and record that. And we learned very quickly how hard it is to do. That like the great, conversations you guys are having, like for us, it's not like we could just jump on and just do it. So I'm wondering like what your lessons are from podcasting. I don't know. You guys have been doing it for at least a few years. What have been your biggest lessons from podcasting?
I think 5 years. And to be honest, it was the same thing for us. I think some people are just natural talkers and natural salespeople. Like we work with Josh and Barry. Those two are just naturals at talking, and they're gregarious, and their personalities are. It's easy for them. Not to say they're not working hard, but that part of their personality. For Michael and I, it was never really like that. We wanted to do that because we thought our conversations were good, because I live in Michigan and he lives in New York, and we were sharing all this stuff about the markets and about our lives back and forth all the time. And we thought, oh, this would be kind of interesting as a forum to talk about what's going on. And it was hard for us because you kind of hit that record button for the first time and you go, oh, wait a minute. It gave me a lot more respect for like radio DJs, like people that can get on and just talk and just by themselves. I have so much respect for, because it's not easy. It's a totally different ballgame than a blog post that you can kind of create and craft and use the right words and perfect phrasing. It's different to have more conversational tone. And we, just like the blog, I have all these drafts I never used. I think we did 5 or 6 podcasts where our producer for the podcast actually said, let's do a few trial runs and see how it goes. And the first time we hit record, when you see that red button go on, we both kind of froze, and it was herky jerky and it was awkward. And I'm sure that a few of the early podcasts are like that, where another thing you have to kind of practice and get better at it. And I think that's something that we've worked on, and it certainly wasn't natural to us at all. It's difficult, kind of. It's a totally different ballgame, the whole communicating and using your words versus writing. And the thing that we, I think, learned from that we kind of underestimated is how much more your audience will relate to you, because it's so much easier to see your personality when people hear you versus when you're writing something, right? I think you can create almost a different version of yourself when you're writing, because you can use different words and phrasing, and it's not necessarily, if you're talking, it's kind of you and your personality, and people get that. And I think one of the things that's helped us with the podcast is that we share our personality and also a little bit of our personal lives about who we are and the stuff we like and enjoy. And it's not just dry finance all the time. It's us, and whether you like it or not, it's kind of who we are. And so that was a big surprise to us, that looking back on it now, it seems obvious, but people, generally like to consume content from people that they like and respect or trust or just find entertaining. And, but yeah, that was another thing that we had to work at it a lot. It was not easy for us, just like it was for you.
Yeah, we've struggled as well. And, one of the things I've kind of learned over time with this is, with writing, I tend to like want it to be perfect. I want, everything to be grammatically correct. Like people don't expect that on like audio and video. If you say, or I mean, no one really cares. Like at the beginning, you're trying to like do it perfectly, but you realize over time that no one really cares about that. It's like you said, it's more about being you, and people are fine, if it's not perfectly delivered, with video and audio.
Yeah. And there are everyone has their own verbal tics or things that they do or say. And the bigger your audience gets, the more people will point those out. You do get a little sensitive to some of those things, and you try to fix them. But some of them, it's kind of like this is who I am. So it's basically like it or not. And yeah, it's been a lot of fun, because you grow an audience and people kind of get to understand you and know you and get on the same inside jokes as you. And yeah, the podcast thing to us, again, we kind of went in with little expectations. We didn't know what was going to happen. We kind of thought, are we going to run out of stuff to talk about? And of course we haven't, because there's just always stuff to talk about when it relates to the markets and the economy. And I mean, especially these last 3 years, there's something new coming up seemingly every day or week, it seems like. So yeah, it's been a fun process, but it's you put yourself out there, and it's interesting.
As a podcast nerd, I wanted to ask a little bit about the behind the scenes stuff. I mean, you guys talk on the podcast about like having sort of a Google Doc, I think, where you come up with, is that how you do it? Do you basically just have, throughout the week, you're putting ideas on a Google Doc and you both sort of just read it in advance and get a feel for the topics, and then you talk about them?
Yes, we have a bunch of categories. So we started with a Google Doc, and we have markets and economy and inflation and crypto and individual stocks and all this stuff. And we've added those categories. And if we see a story or a tweet or a headline or a graph or a data point that we think would be interesting to talk about, we put it in there. And then we kind of, before we do it, we go through it and we try to rearrange it. And that's kind of how we're scrolling through this. And it could be 20 or 30 pages worth of stuff every week. And we don't always get to everything, but that's kind of how, that's kind of how we structure it, where we're just kind of riffing on, it could be 15, 20, 25 different topics per 45-minute to an hour episode every week.
I want to ask you the same question Justin asked you about writing, because a lot of people are starting podcasts these days. And I'm wondering, with your experience doing it for 5 years now, like what are the lessons you would sort of teach to somebody who's maybe starting out with a new podcast now?
Oh, interesting. I do think being yourself is a big part of it. I think, if you listen to all the other podcasts out there these days, you can probably try to copy what someone else is doing. I think you do have to sort of put your own spin on it and do your own thing and not try to be someone else. I thought that same thing with writing too. A lot of people early on told me with blogging that you have to kind of put your own voice on it. Because I asked a few people, like, before getting into it, whether I should do it. And a lot of people said, who are already writing, said, well, of course there's a lot of blogs out there and other people that are already doing this, but they're not you, and you have to be you. You can't try to be someone else who's already doing this, because they can probably be themselves better than you, obviously. So I think personality matters. Being yourself, being, like you said, authentic and transparent, and being willing to share and be open a little bit is probably helpful. I also think you have to do your homework and be prepared. Like I said, Michael and I, we're constantly reading and looking at stuff and sharing thoughts and data. And I think if you're not prepared, then that shows up if you haven't really done your homework, because it shows if you don't know what the hell you're talking about, basically.
Just one more thing on content. Sorry, Jack. I think that you guys do a good job of experimenting, like, with different things. Like the podcast, obviously you've been doing it for a long time, but I know you were doing stuff on Instagram. I don't know if you're doing stuff on TikTok. Obviously the podcast is, big on YouTube. But do you envision or see, like, sort of the delivery of content sort of changing, like the younger generations that are, on TikTok, and their attention spans are like 20 seconds, an hour podcast, 10 years down the road, people might not be consuming content that way. So do you have any feelings on, like, content getting more condensed in a way? I'm thinking like YouTube Shorts maybe, or something like that, in terms of different delivery.
I think it's definitely stereotyping, but if I had to think about it between blogs and podcasts and YouTube, which has kind of been our progression, if I split it up by demographics, this is not perfect, obviously, but the demographics would be, I have a lot of baby boomers who read the blog, and I still get people who email me and say, how do I print out this blog? But people who literally still print it out and read it on paper. That's a big cohort of boomers. Gen X people, I think, are probably more apt to do the podcast, and then younger people, millennials or Gen Y, are probably more for the YouTube. And obviously there's some mix there, but that's kind of the way it goes. But I do think there's probably some room for different kind of stuff. We've actually talked recently about, what if we had just sort of an instant reaction 10-minute podcast where we get out and do it right away. We don't have to have a bunch of editing and done. We do it right away. We throw it right up and just have this more instant reaction, as opposed to something that's longer form and it takes a little while to get out there. And so I think there's probably room for that. I don't know where else this stuff is going in the future, but yeah, we're willing to try and experiment. And YouTube has been we talked about this before we got on and hit record. YouTube has been a surprise to me. That was something that Josh really pushed for a few years ago and said, we need a presence here. There's a lot of young people here who consume all of their content on YouTube. And Michael and I were a little unsure of that, like how that's going to work. And we started putting our full podcast up on YouTube, a few years after the podcast started. And we thought, at first we just put some clips and thought no one's going to pay attention to this. And everyone was asking on YouTube, why don't you just post the whole podcast here? And we thought, well, no one's going to watch a whole podcast on YouTube. Lo and behold, a lot of people do that. They have a second screen at work or something, and they have a podcast, YouTube over here, and their work over here. And that's just the way some people consume content these days. So I think if you have the ability to reach people in different places, it certainly helps to sort of, widen that audience base.
Yeah, on that quick reaction idea, I think that's a pretty cool idea. Like, you guys could do something like, if there's just a Fed meeting, you guys could record 10 minutes, like right after the Fed meeting, and put it up right away. And like, that might actually be something I think people would engage with.
Yeah, and keep it short, 8 to 10 minutes. I think that's something we're going to look into, where people's attention spans are shortening, by the day, it seems like. I
want to shift and talk about some of the stuff you write about on the blog now, because you have this quote on your blog where you said, Albert Einstein once said, if you can't explain it to a 6-year-old, you don't understand it yourself. And I'm having trouble right now explaining to a 6-year-old what's going on in the economy, because we've got very high levels of inflation. We've got a Fed that effectively, I think, is trying to cause, a recession, or maybe not trying to cause a recession, but knows they might have to in order to stop the inflation, but then the labor market is still really tight. It just seems like it's a really, really complicated economic situation to understand. So I'm just wondering what your reaction to it is, and maybe how you think about explaining what's going on in the economy right now.
Well, the Charlie Munger quote was something along the lines of, if you're not confused right now, you don't understand what's going on. And so there's so much, these last 3 years, it seems like we've been through 8 different cycles, right? And people always like to look for analogies to history about this is like the 70s, or this is like the 90s, or this is like whatever it is. And I just don't think that you can find an analog to today. You can find times that were similar under certain circumstances, but just the pandemic after we already had a 10-year bull market, and then this huge speculative excess after we had this huge crash, and then now we had this inflation for the highest in 40 years and all this stuff. And it really is confusing to me, because the Fed is now trying to push us into a recession potentially to calm inflation, and the market is already in the midst of a bear market, and we haven't even technically gone into a recession yet. And so you can be pulled in a million different directions right now, thinking through what the potential ramifications are and where the market is going to go and what it means. And yes, I've been trying, talking this through in the podcast for months and months now, trying to think through what it all means and trying to put it in historical context. And the thing where I've come down to is just that it's really hard to find a situation that's like this. And I think this might be one of the few cases where looking at history might make it even worse for you instead of making it better. Because I do think history can provide a good context. I like to look at a lot of the long-term stuff on my blog all the time, just to show people, what has happened in the past when something like this has happened before. And it's always something in the markets, but this time for sure seems like one of the more confusing times that I can recall in my career.
How do you think the average investor should look at inflation? You're on Twitter like we are, and you'll have some of the smartest people you've ever met, like on both sides of this right now. You'll have people who say like inflation is going to be really, really high for a really long time. This is a massive problem. And then you'll have other people, like I know Mike Green has talked about this, like that, say that like it's already rolling over, like shipping rates and freight are already down. Real estate is rolling over, even if it's not rolling over in the CPI number. Like this thing is already, coming to an end. Like, how do you think your average investor should kind of think about that when there's those major extremes like that?
The other weird thing is that in the past, there wasn't so much data available. Like today, all the macro thinkers, right after the inflation numbers come out, you see a million people dissecting and disseminating, this piece of it did this, and this piece did this, and if this piece doesn't come down to this, and you can look at you can break it up into a million pieces to understand why inflation is doing this, and the calculation of this actually means this, and this is on a lag, and this is actually front running, and there's all these different, so that makes it even more complicated, I think, because you can pull it apart in so many different ways to show whatever you want and have your own confirmation bias. It is interesting how, people think a lot of the longer term stuff that was happening before, we have aging demographics, and we have globalization, we have technology, and all these things seem like a headwind to inflation over time. But yeah, now we have an energy crisis, and we have higher interest rates, and we have more government spending, and that seems like it could keep it higher. And of course, the Fed is fighting as hard as they can now to bring it in and bring down inflation. If the Fed is going to raise rates like this and inflation doesn't come down, what does that mean? So I wish I had a good answer here for this. It is kind of crazy how inflation basically was kind of dead coming into this. The Fed tried their mightiest in the 2010s for the whole decade, basically, to bring inflation up, and they couldn't. And then all of a sudden we have this pandemic hit, and the government spending hits, and we have supply chain issues, and all these different waves of COVID, and that gives inflation, of course, it's way higher than they ever wanted. And it's just interesting how these pivot points happen from stuff that you would never expect and could never predict ahead of time.
Funny, I don't know if this is true of you as well, but I had no idea, like we've had such benign inflation, like in my whole career. Like I had no idea what was even in the CPI. Like if you had tested me on like the percentages that go into the CPI before this whole thing, I would have been way, way off. And now I'm thinking about things like owner's equivalent rent and how it's calculated and like getting in all these details, but I had no idea what the CPI, even was before this whole thing.
Well, it seems like we all have only enough attention for like one thing at a time. So, remember back after 2008, people were paying attention, like what was it, the Dry Baltic Index or whatever, that was the harbinger of things to come. And then for a few years there was the European sovereign debt crisis, and then it's tech stocks, and then so we have all these different things, and it seems like it's always one thing that we kind of really focus our time and energy on. And yeah, now of course it's inflation, and then if inflation does come down, then it's going to be something else. So yeah, you're right. I never bothered to put much into it too, and now I'm checking the BLS data, and it's kind of crazy, and it also makes you realize how easy it would be for people to not be able to predict inflation. Like I think like the Fed themselves has said in this cycle, we still don't know what really causes inflation, right? Like everyone, there's a million different things that probably went into this. You could blame again COVID and supply chains and government spending and all this and pent up demand and people being at home and then now they're spending. There's really not one reason for it, but the Fed themselves puts out forecasts on this, and they're wildly off on this stuff, right? And they're paying attention to this stuff every single day. So I think for the rest of us, it's pretty good to understand just how hard it is to forecast stuff like this.
It's funny, we've had Cullen Roche on the podcast too. I think you've had him on Portfolio Rescue a couple of times as well. And like we asked him, what causes inflation? And his answer was basically, I have absolutely no idea. And so if somebody who's as smart as him has no idea what causes inflation, then probably nobody has any idea what causes inflation.
Yeah, I think that's probably true. I think interest rates and inflation are two of the hardest things to predict. And they're two of the biggest inputs into the markets and the economy, especially right now. So yeah, it's just a good reminder that like staying humble is probably not a bad place to be most of the time.
I do wonder, this is sort of an aside, but I do wonder if we might come up with a better way to calculate inflation out of this, because, when you're looking at this thing, like the CPI report coming out, I think in a couple of days here, and it's like, well, housing is going down now, but in the CPI, housing is going up, and we've got this lagging thing. And I wonder if maybe through technology or something, maybe they'll come up with, you can never calculate true inflation because it's different for every person and it's hard to track. But I do wonder if maybe they'll come up with a better way to calculate it, out of this.
I think that's the hard part is no one would ever be happy with any inflation, that number that you come up with. Because if you're a person who lives in a city and is renting and you've seen your rent go up, or if you have just bought a new car, or you have baby formula to buy, or whatever it is, if you have a couple inputs in your life that are, the prices are going way up, you think inflation is out of control. If you don't have that stuff, if you own a house, you locked in a 3% mortgage, you already bought a car a few years ago, you're fine. You don't drive very much, you're not paying high gas prices. You might think, inflation's kind of it's overestimated, it's not that bad. So you're right, a lot of it is personal. And so I think whatever they did with the number, someone would find a fault in it.
I want to ask you about the pace of change here, because that's something that concerns me a lot that I've been trying to think through on my own. If you think about just how fast bond yields went up or how fast mortgage rates went up, how do you think about putting that into context in terms of like the risks we face because of just how fast this move has been?
Well, I think markets have been speeding up for a while now. I think part of it is just the free flow of information, and markets became more global, and something that happens across the world or something that happens here could impact, your things around the world. And I think social media has sped things up. Like I said, in the past, I wrote about 1987 a few years ago, and a reader wrote back in to me and emailed and said that he didn't know what happened to the stock market until he was driving home and heard it on the radio and realized like his retirement portfolio was potentially just poof, gone. And now we see this stuff happen, as a tick by tick basis, minute by minute basis. And I think it makes it a lot harder for investors to have a long-term mindset because the cycles are happening faster. And I think the central banks and the Fed are a big part of this. I think 2008 really brought the Fed to the forefront where they had to step in and do something. And then 2020, I think they're just stuck with the markets for good. And unfortunately, I think that means probably shorter cycles and faster and more boom bust nature of the markets, because it's going to be hard for them to pull their tentacles out of things. And I think that's just going to make it harder for investors to have more of a long-term mindset if we have these cycles that are just happening faster and faster.
Yeah, and we've been seeing that as well. It seems like everything is speeding up in the markets, and it'll be interesting to see like going forward if that continues, or if maybe things change with that. That sort of gets into one of the other questions I wanted to ask, which is, the bear markets we've seen in the past, several bear markets have all been pretty quick. 2008, dragged on for a few months, but 2020 was really fast, and those in a historical context are really, really fast bear markets. And a lot of people have been sort of talking about the 2000 to 2002 period here, thinking like what we're seeing now might be more like that, and that's more like a typical bear market. So I'm wondering if you could talk maybe about like what you found in terms of the history of bear markets and how like what we've been seeing recently differs from what bear markets look like historically.
Well, I looked at this a number of different ways because I think it's fascinating. So I looked at like the bear market since World War II, so call it since 1945. There have been, I think, 13 of them if you want to include the one right now. And I think the average peak to trough was like 12 months, right? So it takes about a year for stocks to go from top to bottom, and it takes about another 10 or 11 months to break even and get back to where you were before. So it's almost 2 years to go from peak to peak, basically, on average. And of course, there are ones that are shorter and ones that are longer than that. So yeah, the 2002 is the longest. 2000 to 2002 is the longest one. I think that was like a little over 30 months from peak to trough. So that was a long time to bottom. And then a lot of people don't remember this. by the time we got those old highs back, it was basically 2007, and then stocks rolled over again, right? So that was that whole lost decade period where you had two huge crashes in the same decade. But that's actually not the norm. So a lot of people are saying that this could be like that, but that's pretty much an outlier to have it last that long. The only other time that's been longer than that, or kind of close to that, would be like the mid 1970s and the early 1980s, which is the last time the Fed sent us into a bear market, where it took 2 years or so to go from peak to trough and back again. So the longer bear markets like that one in 2000 to 2002, that's actually pretty rare. Now you could say like this is the perfect storm for that type of environment. We had a bull market going into this, then the pandemic sort of supercharged this. We had this what felt like a 1999 period where we had all the speculative excess and things going crazy. Now we have inflation. So if it's going to happen, maybe this is the period for it. But that type of extended bear market, while it can happen, that one is actually pretty rare.
Yeah, I think one of the great things you do looking at this with data is like you learn that there are many, many types of bear markets, and your articles have done a good job showing this. So anybody who's saying like this is definitely going to be a long drawn out bear market, or this is going to definitely be a shorter bear, no one really knows. I mean, all of us like to talk like we know what we're talking about, but it's good to just look at what's happened historically and say, all right, here's sort of a range of possibilities, and no one really knows. We might get any of these.
Well, the strangest one about this one is coming back to the confusing point. I mean, this really is a man-made downturn in stocks. Like the Fed is telling us, we want the stock market to go down. We're raising interest rates. We're going to make that happen. And the fact that it's not like some big catastrophe like we had in 2008, where it was like this financial system excesses that were building for years and years and maybe decades, and it all finally blew up. This is a man-made downturn. And if we do go into recession, it's going to be a man-made recession as well. And so that also means that it might be easier to turn it back and have a man-made recovery if the Fed decides to turn things around and then stimulate the economy. So I think that's the hard part now to handicap is how far are they going to push? How bad is that going to make things if they potentially break something? And then will they just turn around right away and stimulate, and that will put an end to things and market will go right back up? So that's the hard part right now is that the Fed is so entrenched in all of this, and they seemingly just won't shut up about it. They all love to talk about it. There's a new Fed speech every day, it seems like. And I think in some ways they really like the control they have. Back in the day, the Fed didn't say anything. They were pretty tight-lipped on stuff, even in Greenspan's days, about what they thought about what was going on. And that's what makes this one so unique, I think, is that the Fed is such a big part of what's going on.
I was listening to someone this morning, and they were talking about all this gridlock in Washington with the elections. It actually puts more power. The Fed's going to be the only player in town because nothing's going to get done on the fiscal side now. So the monetary side is going to be even more important. So it gives, it still continues to put that. I mean, the Fed's a very powerful, obviously, organization, maybe the most powerful in the world. But it's just, with the election results, it makes that sort of shift in power even more.
And I think that the part of it is, the Fed has been on their own for a lot. Like that, the 2010s, I mentioned the Fed wanted inflation to get higher. They were keeping rates at zero forever and kind of waiting for fiscal policy to step in and help. And it never did. And it took the pandemic to make that happen. And now I don't know, because we got this inflation, if the politicians are going to be shy about using fiscal policy again, if we do get another downturn, or if people are going to be clamoring for those $1,200 checks again. But right now, the Fed the government is kind of, it seems like it has said, like, you're kind of on your own. And the Fed, that's why the Fed, I think, is going so hard. One of the reasons is because they're the only ones who are kind of doing anything right now, because the politicians don't want to be seen as slowing things down and sending us into a recession, right? They can't really have that. Neither side wants that. So the Fed is kind of on their own as this like independent body, and they're the ones who have been kind of left, kind of just floating in the wind. And it's like, kind of, you're on your own. Like, you need to do this and take care of it, because I think they've gotten a lot of blame for what happened because it took them so long to act. But yeah, they're on their own, basically.
I want to ask you about housing, because it plays such a huge role in everybody's lives. And so, that's probably one of the biggest topics you'll see, if you go to a cocktail party or something these days, is like everybody's worried about, getting back to this idea of the magnitude of mortgage rate increases. Everybody's worried, what does it mean for the housing market? And you've got the doom and gloom people out there saying, this is 2008 again, we got a massive housing collapse coming. And I'm wondering, just when you look at it historically, what do you think about putting what's going on in housing right now in context for people?
That's probably my biggest worry about if something happens, the Fed could potentially break something, because mortgage rates have gone from 3% at the beginning of the year to more than 7% now. That, like, we've never seen an increase from that low of a rate to this high of a rate in this fast, especially when you add on the fact that housing prices are up 50% or whatever from, the beginning of the pandemic. And the problem is housing makes up like 20% of GDP. So if you add in things like construction and lending and loan officers and furniture and all the ancillary costs that go into a house and realtors and all these things, it's a huge part of the economy. And I think the Fed, by letting mortgage rates get so high, are effectively just sending that whole industry to a screeching halt. Like there's, no one's going to build a new home right now if mortgages are 7%. There will always be people who have to move. But, if you have a 3% mortgage, you're not going to want to leave that and go to a 7% mortgage, unless you really have to because you have to move for family or a job or something. So a lot of people are going to be stuck. And I think that there's just not going to be much activity at all in the housing market. And I think that's probably my biggest worry right now. Because you're right, that's the one thing. Like Michael and I always talk about topics that we hit on in our blogs or on the podcast, in the stuff that really can get people to, really give a lot of feedback or get incensed or really into a topic. And housing is one of them because everyone has to live somewhere. So everyone has this experience with this, right? Like not everyone owns stocks, but everyone has to live somewhere, whether that they're renting or buying. And so real estate is the most personal of asset classes. And I think screwing with that too much, I think could be a mistake because it's such a big part of the economy. I mean, if you want to take the other side of that, you'd say, well, housing prices are up so much. If they drop 10 or 15%, it shouldn't matter that much because so what? But my biggest worry is just that we're not going to build enough houses because the housing industry itself has seen so many booms and busts in such a short period of time that they're going to say, all right, you know what? We're backing out of this. This is not for us anymore.
Yeah, it'll be interesting to see like when sort of the public and the politicians turn on the Fed. And, to your point, I mean, this could be what eventually gets the Fed a lot more pressure on the Fed is if they start messing with the value of people's houses. If you really start to see significant decline in the value of people's houses, that affects everybody in their everyday lives. You might see some more pressure on the Fed, to stop.
Yes. And people who want or need to move are saying, I can't afford this. The monthly payments, I think the monthly payments are up like 80 to 100% if you include the house price gains and the mortgage rate gains. It doesn't make sense because incomes obviously haven't kept up with those gains and just it makes it untenable for people trying to afford a home.
Yeah, it'll be interesting to see how it plays out. This is like all the other topics we've discussed. Like I'm certainly no expert and it's probably none of us can predict it, but yeah, it's going to be a major part of what happens to see what plays out with housing. I want to shift and ask you about a couple of things, that we look at a lot as quant investors. And first I wanted to ask you about factors. And I just want to get your general idea on like using factors like value in a portfolio, because, you've kind of got different camps out there. You've got people who say, indexing is really the way to go for investors. And then you've got other people who say, all right, using things like factors, you can get a little bit of an excess return. Obviously you have to be able to stick with them through the ups and downs, but you can. And I'm just wondering, you've talked about like things like value in your blog over the years. And I'm just wondering, what are your thoughts like on factor investing and how your average investor should look at it?
I've never looked at factors as a way to get alpha. I know if you look back at the research, it shows that certain factors like value or quality or momentum have outperformed the markets over time. The way that I see them is as a form of diversification. And I think this period over the last 24 months is a perfect example of it, where certain stocks perform better under certain economic environments. And I've written on my blog over the years that it's not a certain, it's not the only input, but value stocks tend to do better when inflation is high or rising and interest rates are high or rising. And we just haven't had that environment in a long, long time. So everyone thought, well, value is dead because for 10 or 12 years, growth stocks kind of crushed them. But that was an environment of falling inflation and very low interest rates. And it was a much better setup for growth stocks. And now that we've seen the opposite of that, I think owning different stocks and different factors like that can help you in different economic environments. And I think that's the biggest case for owning different factors in your portfolio is just you're diversifying by different market environments, and having a value tilt in your portfolio in some ways can help with a situation like this, or high quality or dividends, or however you want to define it. I think it can help when you have a different market environment that doesn't help with. So I've never been a person who likes to go to extremes, and I'm going to own all tech stocks or all dividend stocks or all value stocks or whatever. I like to have a little bit of each because I don't think I have the ability to predict what the future is going to hold, and I don't have the ability to predict which factors or which strategy is going to perform best. And so that's why I think diversification is such a strong tool, because it doesn't mean you're going to outperform, but it definitely means that eventually you're going to hold the winners depending on the environment. Yeah,
that's been one of the biggest lessons of my career, building quant portfolios is, you've kind of explained it in layman's terms, but that's the same thing we kind of look at behind the scenes with quant portfolios is like, I used to be all right, let's use value. I'm a big believer in value, so I should have this huge weighting to value. But, really like taking a multi-factor approach or like putting different things, putting your eggs in different baskets, that tends to be the best thing for everybody, particularly from a behavioral standpoint, because this stuff can be really, really hard to stick with. Like that 10 years of struggling for value, like your average investor is not going to sit through that. So, like you said, doing a lot of different things is probably the way to do it if you're going to attack if you're going to attack investing with factors.
Especially if your whole portfolio into something. That's why the extremes are such killers, because no strategy is going to outperform in every and all environment. If that strategy did exist, all the money would go into it, and then it would probably be arbed away anyway. So I think that's the good lesson, is that like there's no investor or there's no strategy that's good enough to outperform in every market environment.
The last one I want to ask you about about trend following, because it's something I think you guys do in some of your portfolios, and it's something we do as well. And we have some challenges with it, and it also can have some really good things attached to it. The great things are, it reduces drawdowns at a period like this, sometimes significantly. The hard part is it makes someone's portfolio look a lot different than the market. And so there can be the cocktail parties where their neighbor's making big money in the up markets or like in a market that's going back and forth, and you're out of it due to trend. So I'm just wondering what your thoughts are in general on trend following.
I was pretty late to the trend game. I was always a sort of buy and hold boglehead investor from the start. And it wasn't until I really got to know people like Meb Faber and Wes Gray and some of the research they did and some of the papers they did that trend made a lot more sense to me. And I think the thing that drew me to it wasn't so much the strategy itself or the results. It was the behavioral side of things. And I think a strategy like trend is something of a behavioral release valve for someone. If you have it as part of your portfolio and you have one of these severe market dislocations like we're going through now, that's the kind of thing that it can save you from is some of the volatility there. And I think if you have that piece in your portfolio, whatever it is, whatever that other strategy is, if it allows you to keep the rest of your portfolio invested and fully invested and not tinkering with it, I think from a behavioral standpoint, it helps a lot. And I also think the thing that started to click for me with trend is just that it's a way to diversify across market cycles. So it's a different form of diversification where you're trying to stay invested during the upturn. And I think that's the hardest part for a lot of people with any sort of hedged strategy. And I had a lot of problems because we in my institutional portfolios were invested in hedge funds back in the day. And my biggest problem with them is that they could never keep up during bull markets. And I think most trend strategies aren't going to keep up fully. But these hedge funds were not even coming close, right? And at least I think a trend strategy can keep you invested for the majority of the upside. With occasionally you're going to get whipsawed out of these things, but I think that's the thing is that most hedged products, you just get crushed during a bull market, and you're not going to stick with them when you need to during a bear market. So if you have a strategy like trend that can keep you invested for as long as you can until the signals hit, I think that's one of the things that was the most alluring to me is obviously the downside volatility and keeping in a correction, keeping you a little safer. That makes sense, but also keeping you invested on the upside and then having an out on the other side, even though you're not going to top tick things, just having some rules in place, to help guide you. I think that's the biggest thing for trend for me.
Yeah, if anybody's going to try to limit losses in a portfolio, the worst case scenario is kind of like, Jack decides when to get in and out of the market, and I'm going to try to use my own things. At least it's an automated process. And I think that's a huge benefit of it is, there's rules you follow and your emotions don't get, caught up in everything.
Yeah, because right now is the worst time to try to guess when should I get back in. Like if you don't have any, if you got out, good for you. But if you got out because you thought like, oh, I'm worried about the war or inflation or whatever it is, or valuations, what's going to be your trigger to get back in? And that's why I think rules are so important for something like this.
You write about investor behavior, and you've mentioned investor behavior a couple of times here. And we know that sort of behavior and biases can get us in trouble in investing. And a lot of people, hurt the returns because of bad behavior or binary decisions or whatever. But, and you've mentioned diversification, but what else do you guys sort of focus on at Ritholtz to help improve investor behavior and help your clients sort of get the most out of what you guys do?
I'm one of these people who thinks that overall investor behavior has gotten better over time. And I think a lot of the tools that we have and technology has helped there. I think if you would compare investors now versus like the 80s or 90s, I think people are probably a lot better off. But I think the problem for most people comes at the extremes. When you have a situation like late 2020 and early 2021, when FOMO was just off the charts because I'm not invested in this and I'm not invested in that, and look at this scream higher and this person's getting richer. I think at the extremes, it's really difficult for people to keep their heads. Same thing now during a bear market where things are going down and falling in value. So I think that's when you really need the behavioral stuff. And I think for most people, it just comes down to simply having a plan in place. And I think for regular investors, it's like even a bad plan is better than no plan at all. And so I think for the way that we view it is we can't invest money for a client unless we understand their goals and their circumstances and their needs. And so like the portfolio is obviously a big part of any financial plan, but it's not the only part. There's a lot more that goes into it besides the portfolio and what's going on in the markets in investing. So we think that the financial planning piece is a very important part of it too, and understanding how things like tax and estate planning and insurance and all these other things affect you. But I think for most people, it just comes down to having some sort of plan in place. And I think a lot of it comes down to just understanding yourself and knowing which strategy works for you. Because I think perfect is the enemy of good for a lot of people when it comes to investing, that they think that they have to have the perfect optimized strategy. And like, that's only going to be known with hindsight. Like, no one knows what the perfect strategy is going to be going forward because, you only know what was the perfect strategy for the past. And I think that's the hard part, is just keeping a consistent strategy and kind of sticking with it come hell or high water.
Yeah. If someone says to you they have the perfect strategy, you probably want to head for the hills.
Yeah, it's because it really doesn't exist, right? We've all seen great back tests that look lovely on a spreadsheet, and then you put them into the real world and then they look awful, right? Because it's easy to sort of torture the data and make it say whatever you want it to say in the past.
I want to ask you about direct indexing, because I believe you guys are doing some direct indexing at the firm for certain clients. And, one of the things that I'm seeing more of, I'm sure you've seen it too, is, it's starting to come to the individual level. I think Validea, Schwab, and some of these other brokers, are starting to promote direct indexing to individual investors. So, maybe could you just talk about what direct indexing is and how you guys are actually using it for your clients?
I'm a big fan of direct indexing. The people at O'Shaughnessy showed us their Canvas platform, and we were kind of blown away a few years ago when they showed it to us. I actually think it's probably going to be bigger in the wealth management field for advisors than it is for individuals, because there's a lot of circumstantial stuff that goes into it and a lot of planning and heavy lifting ahead of time, because you can create these unique portfolios based on certain circumstances. So if someone comes to us and they have 80% of their net worth tied up in Google or Amazon shares because they worked there and they got these stock options and they want to sell that down and they need a tax budget. Direct indexing is a great platform for dialing up tax loss harvesting, because you're buying the individual shares and you can offset some of the individual companies, because in any given year, even if the stock market's up, something like 30 or 40% of the individual stocks are going to be down, even in an up year for the market. And you can kind of use those for tax loss harvesting purposes. And so I think for most individuals, it's probably more of a financial planning tool than it is for something you can just kind of be like a robo-advisor. I think that the tax loss harvesting stuff makes sense for some individuals maybe, but I think knowing what our financial advisors are doing with our clients, there's a lot more heavy lifting and financial planning and unique circumstances that go into it than just simply checking a few boxes or going through a questionnaire and then filling it out. So I think it's going to be bigger for the wealth management industry than it is for like individuals, something like Vanguard or something. I don't think it's going to compete with something like ETFs, but I think in like the RIA space, it's going to be huge.
Yeah, interesting. Yeah, it'll be interesting to see. And it's been around for like 20 years anyways, but it's finally just given with technology and fractional shares and the, zero commissions, it's made it feasible.
Yeah. The zero commission thing was the biggest part, is when Robinhood forced everyone into that, and it made more sense where if you're buying hundreds or thousands of securities, it doesn't cost as much anymore. That was the big thing that really made it feasible and cost effective. Otherwise, what's the point of it if you're spending all this money buying and selling shares?
Just two more closing questions here. One, I guess they're both maybe a little philosophical, but we'll see. So what do you think in thinking about your investing career, what do you think you've changed your mind the most on?
I was probably, when I first started writing my blog, I was probably under the assumption that there is a right and a wrong way to invest for everyone. And I can come in and kind of, if people just want to learn, it's easy to learn the right way to invest. And I think I've certainly changed my mind on that I don't think there's a right or wrong way for everyone. I think there's a lot of different ways that you can succeed in the markets. The ways that you fail are probably all fairly similar. You don't have a plan. You buy when stocks are high and you sell when they're low, all these things, behavioral challenges. But I think depending on your personality and emotional makeup, there's probably a lot of different strategies that can succeed as long as you're willing to stick with them. And I don't think that there necessarily has to be a right way or a wrong way for people to invest. And unfortunately, I think one thing I've learned is that for there to be a winner in the markets, there probably has to be a loser too on the other side of those trades. And I think everyone can't really succeed, unfortunately. I think there's always going to be people there that are going to be making mistakes and not learning the right lessons. And I think that's just how markets work, unfortunately, over time.
So we like to ask all of our guests a sort of standard closing question. And that question is, and maybe your response that you just gave might be part of this answer, but we'll see, is based on your experience in the markets, if you could teach one lesson or impart one piece of wisdom to your average investor, what would that be?
Yeah, that's probably pretty similar, but I think there probably is no perfect way to save and invest. There's no top 10 list you can read, or there's no book you can read that's going to like completely change your life and make it easier for you to figure it out. I think you just have to kind of pick a strategy and then stick with it come hell or high water. Because I think one of the hardest parts is these days we can always see how other people are saving and investing, and this person is investing in this. And I think it's probably never been a better time to be an individual investor in terms of the strategies and products and tools we have available. I mean, if you think about some of the strategies that are now offered in a tax efficient ETF that were only available to rich individuals or institutions or hedge funds back in the day, and individuals can now use these same strategies for pennies on the dollar in terms of costs. That's a great thing. The problem is there's so many choices these days for what you can invest in that it makes it much harder for people to stick with a strategy. So I think for most people, the good strategy you can stick with is vastly superior to the great strategy that you can't stick with. It's just really hard for people to find that one strategy and stick with it. So I think that's kind of the lesson I'd impart on a lot of people is just, if you find a strategy that works for you, don't worry what everyone else is doing and just stick with your own strategy and call it a day.
Good stuff, Ben. Thank you very much for joining us today. I've enjoyed this conversation. I knew I would. How many miles are you going later for your run? What are you putting in?
Oh, I don't go for a lot of distance. 3 or 4 miles. 3 or 4 miles is good enough for me.
All right. Well, this has been great. Thank you.
Thank you, Ben.
Thanks, guys.
Hi guys, this is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJ Carbonneau. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.